This generated simulation illustrates modern financial clearing pathways. Millions of data packets flow constantly between originators, financial institutions, and third-party service providers. But as transaction speeds increase, these pathways become highly susceptible to unauthorized data extraction. Payment instructions are intercepted and diverted before the system registers it. The Nacha 2026 rule amendments address this vulnerability by ending the era of passive ACH clearing. Under the new framework, originators, originating depository financial institutions, and third-party service providers can no longer simply route payments and wait for settlement. They are mandated to actively monitor transactions for fraud and anomalies on the front end before the funds ever leave the account. This diagram maps the compliance timeline. Phase 1 goes into effect on March 20, 2026. This vertical boundary isolates ODFIs, large originators, and third-party senders that processed more than 6 million ACH transactions in 2023. They are subject to the active monitoring mandates first. By June 19, 2026, the mandate expands outward. Every remaining corporate originator and participating party in the ACH network becomes subject to the rules, regardless of their annual transaction volume. Historically, payment networks relied heavily on post-fraud recovery. Financial institutions reacted to unauthorized diversions after the settlement cleared, initiating slow recall procedures that often failed to recover the stolen capital. The Nacha 2026 amendments reverse this operational liability. Identifying and preventing fraud is now a rigid, pre-settlement requirement, specifically assigned to the originators and their immediate routing partners. Failure to deploy these front-end controls expose organizations to severe penalties. Nacha can issue direct compliance fines. Regulators can audit deficient procedures, and continuous violations can result in total suspension from the ACH network. Meeting these stringent mandates requires organizations to abandon legacy manual reviews and construct a fully automated, risk-based data architecture. Nacha 2026 compliance is an engineered restructuring of how an organization processes financial trust. To understand how this architecture functions, we need to examine the mechanics of a single transaction packet. Threat vectors like business email compromise and payroll diversion succeed by exploiting the lack of contextual data attached to these individual packets. This diagram illustrates a standard pre-2026 ACH packet. It contains routing instructions and an account number, but it is completely devoid of context. It tells the network where to send the money, but provides zero verifiable data regarding why the transfer is occurring. The first compliance mandate solves this data vacuum. Organizations must inject strict company entry descriptions into their ACH credit and debit entries. A standardized tag, distinctly coded as either payroll or purchase, locks into place alongside the routing data. This standardized text provides a rigid payment story. It tells every downstream financial institution exactly what type of transaction they are processing, providing a baseline metric to measure against. With these tags in place, the network can screen for a purpose mismatch. This occurs when the newly attached metadata explicitly contradicts the known profile of the recipient's bank account. If a corporate CCD transaction is submitted but is tagged as payroll, the scanner detects a logical clash. A corporate entity should not be receiving individual employee wages. The system flashes a hard rejection signal because the data points contradict one another. Originating and receiving depository financial institutions use these explicit mismatches to programmatically intercept anomalies before settlement. Standardized tags force payments to align with their stated intent. This mechanical check blocks external bad actors from spoofing invoices and prevents internal employees from silently redirecting off-cycle payroll files to unauthorized accounts. Data richness turns a static, easily manipulated payment instruction into a self-verifying asset that actively resists interference. Securing a single packet is only the first step. Treasury departments process millions of these instructions every month. Many financial leaders assume their existing manual 4-eyes approval workflows, where 2 separate employees sign off on a batch, will satisfy the new rules. Relying on human reviewers to spot micro-anomalies across massive, high-volume B2B payment files guarantees high error rates and severely throttles business velocity. Nacha specifically mandates commercially reasonable fraud monitoring. At modern transaction volumes, this standard dictates the use of automated controls capable of operating at scale. This diagram outlines the required solution. an automated risk-based routing architecture. Incoming packets hit a central algorithmic matrix that instantly calculates a prepayment risk score based on specific anomaly detection logic. The algorithm scans for high-risk triggers, first-time payments to an unknown vendor, sudden bank detail changes for an existing supplier, and large-value off-cycle payroll runs instantly escalate a packet's risk score. Packets that match pre-verified profiles and show no anomalies receive a low-risk score. They bypass the matrix logic and travel down a high-speed primary rail for immediate processing. When the algorithm flags a high-risk trigger, that specific packet is physically diverted from the primary rail and locked into an isolated holding chamber for strict review. Algorithmic prepayment scoring parses thousands of data points in milliseconds, achieving a detection rate completely impossible under legacy batch review constraints. Automation optimizes the 4 eyes principle. It filters out the noise, preserving manual human judgment strictly for the anomalies that machines have isolated. Once a high-risk transaction is locked in the exception queue, the organization must resolve the anomaly before the funds can be legally released. Nacha requires originators to confirm that the recipient account is owned by the intended payee. This diagram illustrates the preferred resolution method. The holding chamber pings an external database node to validate ownership. The node returns a match status for the account name and routing number, triggering the packet's release into the active stream. If the automated data source cannot confirm ownership, the originator must initiate a manual fallback protocol. Staff must establish direct contact with the vendor, outside of the compromised email chain, to validate the new routing details. Executing this verification process only satisfies half the mandate. Logging the exact evidence of the check is the crucial legal requirement. Every released exception must generate a permanent, structured receipt detailing 3 components: the specific verification method used, the exact date and timestamp of the check, and the final outcome. These searchable logs provide audit-ready evidence for financial institutions and regulators, proving that commercially reasonable controls were actively applied prior to settlement. The verified data is then fed directly back into the scoring matrix, updating the vendor's profile to ensure future payments process via straight-through logic. If a fraudulent transfer occurs and the originator cannot produce the specific log, the liability for the lost capital shifts entirely onto the originator. Under the 2026 rules, an unlogged verification is treated legally as no verification at all. The recorded evidence is the compliance. Zooming out, we see the output of this architecture. This visualization maps a modernized Treasury ecosystem processing high-volume transactions at massive scale. Deploying strict algorithm-driven fraud defense aligns perfectly with the broader modernization goals driving the B2B sector. Nacha is actively expanding the same-day ACH processing limit to $10 million per transaction. This chart tracks that expansion. As transaction value limits rise, the potential damage of a single compromised packet escalates proportionally. This exact risk profile necessitates the rising threshold of automated verification gates we just explored. Establishing these high-limit, low-friction pathways allows wholesale corporate entities to manage global liquidity and settle cross-border transactions within a single banking day. Treasury modernization is also integrating agentic AI to autonomously manage cash flow consolidation and perfectly optimize complex exchange rates. These autonomous tools require pristine inputs to execute complex mathematical routing. Standardized data, like the payroll tag, prevents AI models from hallucinating context and executing critical errors. The March and June 2026 deadlines are rapidly approaching. The technical integration of AI-powered detection and verification tools requires a 12-month development cycle. Starting this process after 2025 leaves insufficient time for system testing, increasing the risk of rejected batches and network penalties. Treasury leaders must act immediately, conduct internal workflow audits, demand compliance readiness from processors, and allocate necessary technology budgets. The Nacha 2026 rules systematically dismantle weak security protocols, while actively rewarding automated, data-rich Treasury architectures with maximum operational scale.